Hello, everyone. Welcome to Toronto Centre's webinar on supervisory independence, safeguarding effective supervision. My name is Blavatnik. I'm the president and CEO. We're delighted to be hosting over 320 people who've registered for this webinar, representing 78 countries, including developed and developing emerging market countries, about 62 agencies. So I think there's a lot of interest on this topic. And your strong participation reflects the importance of the topic for financial stability worldwide. Supervisory independence matters and is widely recognized as a cornerstone of effective supervision. At a time of growing geopolitical uncertainty and competing policy pressures, the independence of financial supervisors remains one of the most important safeguards of financial stability. Just an anecdotal point for those of you who are from developed jurisdictions, this independence is not an abstract thing. In many developing jurisdictions, supervisors can actually be criminally charged, go to jail. I have tried to help some of them in these cases. So we're talking about matters that are really, really important. Now you add the geopolitical layer on it, then you come up with a much, much stronger confluence of events. Supervisors, why does it matter? They must be able to make decisions based on sound judgment, evidence, and public interest, particularly when those decisions may be difficult or unpopular. Independence helps ensure supervisory action remains focused on maintaining financial stability, protecting depositors and policyholders, and supporting the integrity of the financial system. At the same time, independence does not mean operating in isolation. Supervisors must also maintain strong accountability, transparency, and governance. Achieving the right balance between independence and accountability is essential to sustaining public trust and ensuring that supervisory institutions can carry out their mandates effectively. I think today you're in for a treat. The discussion will explore all these matters that I talked about, and we have assembled a very strong panel for this conversation. Just a quick bio note for those of you who may not know much about Toronto Centre. We were established in 1998, and since then we have trained over 32,000 supervisors and regulators from 190 countries and territories on matters related to financial stability, financial inclusion, AML, crisis preparedness, risk-based supervision, and much more. Our distinguished panelists today, and I've seen all of them speak, and they're excellent speakers, and I think they'd be delighted to receive questions from you. So please post them, although our moderator will be the one to moderate and put the questions forward. So Kevin Stiroh is Senior Fellow at Resources for the Future and the former Executive Vice President at the Federal Reserve Bank of New York. Brings extensive experience in financial stability policy and supervision. Our good friend Elsie Addo Awadzi is a visiting fellow at the University of Oxford and a member of Toronto Centre's Board of Directors, and previously served as Deputy Governor of Bank of Ghana and has deep expertise in financial regulation and governance. And by the way, she's a very popular speaker at Toronto Centre webinars. And our moderator is a wonderful, fabulous Clive Briault, the chair of our Banking Advisory Committee at Toronto Centre, and one of our long-standing instructors, and I have enjoyed working with him for a very long time. He brings extensive experience in financial supervision and regulation, and also how to effectively teach that. And before I pass it to Clive, I want to thank Jake and Demet and other members of my team who work so hard to bring these webinars for you, and we're very grateful to your participation. Clive, now let me turn the discussion over to you. Thank you.
Well, thank you very much, Babak, and good morning, good afternoon, or good evening to everyone. And thank you for everyone who's joined the call. And again, many thanks to our two panelists today, Elsie and Kevin. I should also perhaps just mention a word of thanks to our translators today. So you can enjoy the proceedings in either French or Spanish. Just look out for the interpretation or translation icon at the bottom of your Zoom screen. So that's probably enough, thanks for the time being, or else it'll begin to sound a bit like the Oscars ceremony at the weekend. And let me turn to the subject of today's webinar, namely independence. I can still remember being at the Bank of England when it was granted independence from the government for the setting of interest rates back in 1997. And the basic idea behind such monetary policy independence, which of course was implemented in many countries, was that an independent central bank could pursue an inflation target more effectively than leaving it to a government which might end up giving in to short-term pressures to boost the economy, not least when elections were looming. But it was never intended to be unconstrained independence. Central bank governors are typically appointed by the national government. Governments set the inflation target, and governments could always take away the independence that they had granted. And moreover, most central banks have put in place elaborate accounting and accountability and transparency procedures to guard against what you might call the democratic deficit of giving key powers over monetary policy to unelected officials. So I think the question today is how does all of that read across to the independence of supervisory authorities, irrespective of whether they are located in a central bank or a separate authority? Why do they need to be independent? How does that enable them to pursue their objectives more effectively? What would they do differently from the decisions and actions that a government might take if it was in charge of financial supervision? What accountability mechanisms are needed to protect again against the democratic deficit? And why, just as with monetary policy in various countries at various times, might this independence be under threat? So those are the questions that our esteemed panelists will be addressing today. And just before we start, one last piece of housekeeping. We do have half an hour at the end of the session for your questions. So do please submit them at any time, but please do so using the Q&A function on Zoom. I'm sure there'll be plenty of questions and I will review them and select some for the panel to answer. So without further ado, on to the questions. And the first question, a fairly general one, I'd like to pose to both Elsie and Kevin, which is that supervisory independence is widely seen as being essential for effective financial supervision. But from your experience and perspective, why do you think that supervisory independence matters? How does it help supervisors to meet the mandates and objectives that they have been given? So Elsie, over to you first on that one, please.
Thank you, Clive, and thanks for having me on this panel. Thank you to Turner Center for inviting me. Supervisory independence, as both Babak and yourself have said, is still very critical to helping supervisors do the work for which they're set up to do. And I like to think of it in at least four ways. So I think of it in terms of the institution and how it's independent, it's set up to be autonomous from other players in the market. And then the people who work there, so the individuals, and the level of autonomy that they enjoy. And then the function, i.e. supervision, and how autonomous that might be. And I like the fact that you talked about the central bank, because the central bank has different functions. It may be a supervisor or not, but even if it is, you do have other functions that are played by the central bank. And so how does that functional autonomy look like in terms of its work as a supervisor? And if it's not the central bank that's the supervisory authority, how does both the institution and its people sort of engage with the function of supervision and how autonomous that might be? And then the last being the budgetary autonomy in terms of how well resourced and how much the supervisory authority is able to manage its own budget, to support its work. All of these are extremely important in the times we live in. Number one, the extent to which the supervisory authority is able to demonstrate that it is independent, then helps a lot of credibility build up for it, right? So trust is at the core of financial systems, and you need to ensure that the supervisory authority is independent not only from politics and government, but also from the industry that it supervises. And that's an often sort of forgotten part of things, right? The industry, it's got to be independent from the industry itself so that all the various stakeholders that are affected by its decisions have a sense of fairness, impartiality, and the lack of bias. And then it's able to more confidently do its work, and it's able to at least gain the confidence of the players that are neutral, at least. So that's important. And ultimately, I would argue that without independence, there's no trust, and the supervisory authority is not able to achieve its ultimate objective. There may be intermediate objectives of safety and soundness, of consumer protection, market integrity, financial integrity, financial market efficiency, if it's a securities regulator, and so on and so forth. But ultimately, all of that must work towards financial stability. And I would argue that without independence, you can't achieve that.
Okay, thank you very much for that, Elsie. Over to you, Kevin, on the same question, please.
Great. Thanks, Clive, and thanks to the Toronto Centre for hosting this event. I think it's a very important set of questions and a very timely set of questions. For me, the question of supervisory independence is really a two-part question. First, why do we supervise and regulate banks at all? And then second, given that rationale, why do we think that independence will make supervision more effective? So I'll start, why do we supervise and regulate banks at all? And the standard theory is that there's some sort of market failure in a critical industry for the economy. Economists have pointed to information asymmetries between borrowers and lenders and depositors, and externalities associated with bank failures. And all of that has created different policy responses, such as deposit insurance, lender of last resort responsibilities, that help to protect the economy from distress in the banking system. Those protections, however, can create moral hazard and lead banks to take on more risk than is desirable from society's perspective. And that's the fundamental motivation for oversight through the regulation and supervision of financial institutions to achieve those broader social objectives. So this whole framework of supervision and regulation is based on the idea that society, through elected officials, has defined some set of objectives, like promoting a safe and sound banking system, financial stability, financial market integrity, and then supervisors and regulators have very specific responsibilities to take actions within law to achieve those objectives. So now to the second part of the question. Why would independence make supervision more effective in that framework? And I'll follow the literature and distinguish between two types of independence: target independence and instrument independence. And by target independence, I mean the underlying objective. What are supervisors trying to achieve? For example, a safe and sound banking system, depositor protection, financial stability, etc. And instrument independence refers to the tools that supervisors use to achieve those targets. And in my view, supervisors should have relatively little target independence, which should be set by the elected officials, but considerable instrument independence in how they go about achieving those objectives. And the challenge, and Elsie mentioned both of these, is that different actors within the financial system or the broader society might have different objectives along different timelines than supervisors. This is often expressed as concerns like political interference or regulatory capture. So, as one example, parts of the government might have an incentive to promote short-term economic growth through more credit provision. That has the potential to conflict with an objective centered on safety and soundness or financial stability. On the other hand, the financial sector itself might have a goal to increase profits in the short term and are willing to take on more risk than a safety and soundness supervisor might desire. And in fact, if you believe that financial sector externalities are the key motivation for supervision, then that would be true by definition, that the financial sector would take on more risk than society might prefer. So supervisors could face pressure to achieve these alternative objectives that differ from those that are their assigned core statutory purpose. And Elsie walked through a number of the steps that have, or processes that have been put in place to try to ensure that independence around personnel decisions and transparency and accountability and budget processes. And we can talk more about all of those. But at its core, I think independence improves effectiveness because it keeps supervisors focused on their statutory objectives and responsibilities, whatever they may be.
Well, thank you very much for that, Kevin. Some fascinating points there. And I do just want to acknowledge that the first question has arrived in the Q&A function. So thank you very much for that. I might say a little bit more in that just a second. So on to the next round of comments, and starting with you, Kevin, a question for you, which is generally speaking, and as I mentioned in my opening remarks, in terms of the democratic deficit, as it's sometimes called, independence should coexist with accountability. But what accountability mechanisms specifically are needed to support the independence of supervisory authorities? And how should supervisors balance independence with accountability and offering some form of democratic oversight? So where do you see all of that playing out, Kevin? Thank you.
I think it's a critical part, and in some ways, independence and accountability aren't substitutes, but they're both core elements of an effective design. So if I go back to the framing that I used earlier around target independence and instrument independence, it seems entirely appropriate to ask supervisors to demonstrate how they are using their instrument independence to achieve those externally set targets. Are you identifying risks early? Are you taking appropriate steps to promote more effective risk management? Are you being careful not to push too far in a way that could undermine a competitive, effective financial system? So that's the accountability aspect. And the literature has identified a number of very practical steps to promote accountability. Things like legislative and executive oversight, expectations around clarity of objectives and transparency around actions, clear management of how budgets are being used. I like the phrase that Andy Haldane, formerly of the Bank of England, used to describe this as ex ante constraints on activities and ex post accountability mechanisms around the outcomes. So let me take just a minute to focus on transparency, because I think that is critical in terms of how supervisors explain what they're doing in support of their statutory objectives. And I'll use the US as an example because that's where I'm most familiar. So in the US, the heads of the 3 federal banking regulators face regular legislative oversight. They testify before Congress and they answer questions about their objectives, about their outlook for risk, around how they're executing their responsibilities. And they take a wide range of questions about how they're working to achieve their mandates. As a second example, at the Federal Reserve, they now publish a semi-annual report, a supervision and regulatory report that includes explicit discussions of the key supervisory programs, recent supervisory findings, the priorities for different cohorts of banks. And that, I think, was a very valuable addition that helps the US federal banking regulators provide transparency around its supervisory and regulatory work. A second example, I think, which is also very interesting, and I've always been impressed by the work of the Office of the Superintendent of Financial Institutions, OSFI in Canada, who published a risk appetite statement for their bank supervisors that explained how they think about risk from the supervisory perspective. And that statement explicitly stated that OSFI has, quote, a high appetite for early intervention and a low appetite for surprises. They talk about a desire for agility and efficiency over perfection around decisions. So that gives a very clear understanding about how supervisors are going about implementing their actions in a way to achieve their broader statutory goals. And I think that type of transparency is essential so that the government and the public can make informed assessments about how effective supervisors are. It will ensure that they're using their tools well to achieve their stated goals. And it will also ensure that supervisors are staying within their statutory mandates and not pushing too far in terms of taking on new targets or new objectives. And both are critical. Thanks.
Okay, thanks a lot for that, Kevin. And on to a question for you, Elsie, which is that supervisory independence can face pressures from many directions, constrained resourcing, fiscal budget constraints, political economy dynamics, complex mandates, and the need to work with other stakeholders. So from your perspective, what do you see to be the main risks that can weaken supervisory independence today, and what safeguards can help to protect it? And perhaps just within your answer to that, you could pick up on a couple of the questions which have already popped up in the question and answer box, which I think relate to this. So the second half of the first question said, does the independence of the financial supervisor become compromised when its budget is financed wholly or partly by the central bank, or indeed by the regulated industry? And a second question there about how can a supervisor ever be truly independent if it is not self-funding, because it will always be funded by another party, be it the government or the industry. So two quite similar questions there, but I think they both relate to the central questions that I wanted to put to you anyway. So are you happy to take those on, Elsie, please?
Sure. Thank you so much. Let me just say this from the onset, that supervisory independence does not mean isolation. And I think this is a point that was made earlier on. And so invariably, supervisors are going to be working with other stakeholders, okay, and are going to have to sort of engage with other stakeholders in different ways. The risks that supervisory authorities face these days are varied and are more pronounced in certain regions or in certain countries than others. And some of these risks might be more of a problem than others, but I'll share a few here. And the reason I start off by saying independence is not in isolation, or is not, it doesn't mean isolation, really starts on the point that financial system sort of policy is actually made by government at a very high level, right? So in many countries, a finance minister decides even what the architecture of financial supervision should be, whether it's a Twin Peaks, whether it's an integrated supervisor, and so on and so forth, and also what the rules of engagement should be at a very high level, at least through primary legislation, right? And then it goes to Parliament, for example. And so that high level policy is one context that a supervisory authority, while sort of being autonomous, is required to engage with, right? And then I think it's Kevin that spoke about reporting to Parliament, for example. In some countries, the supervisory authority is not by itself able to go to Parliament to report. It's got to go through a Minister of Finance, for example. And so there's that, constant interaction. And that introduces some political support but also sometimes some political pressure, and I'll get to that in a minute. There's also the point that financial stability as a goal is ultimately a public good that government or the state is interested in. And so, if you will, the government is the final sort of guarantor of financial stability. And the reason why we have deposit insurance that typically would have, even if pre-funded by industry, would have a fiscal backstop at the tail end, right, if necessary, to help promote sort of payouts to depositors, etc., or to insurance policy holders, or etc., that the fund is able to borrow from the Treasury, for example, at least on a temporary basis. And so all of these determine or somehow shape the relationship between the supervisory authority, whether it's supervising banks or insurance firms or securities and pensions. And it is really important to note some of the points that Kevin made, and that's where the ex ante transparency and accountability measures are so key. To what extent do these relationships exist? To what extent is the supervisory authority required to engage with government concerning high-level policy for financial system stability and etc.? And what is the role of the supervisory authority? At what times are these engagements? And so on, and how public are these engagements, right? In some contexts, for example, the supervisory authorities are required to publish any directions they receive from the finance minister concerning anything related to financial stability and etc. So all of those can be very important. Now, we're seeing a lot of mandate sort of expansions, right? And for good reason. I tell you, for example, that the climate risk that's emerging is real, and every financial services supervisor is having to understand what those implications are for the balance sheets of the industries that they supervise, right? So that's one point. You do have other emerging threats like AI, cyber, stable coins, etc. All of these risks are evolving and playing out in ways that financial supervisors alone cannot control. You do need some national backbones that are helping to deal with these risks, right? Whether it's cyber, whether it's climate, and etc. And so again, the question is, how does the supervisory authority work transparently with other stakeholders in country or internationally? And how can we all be sure that it is not being unduly sort of captured in the way it does its work? So clarity in terms of how it operates amidst all of these pressures. You're seeing, for example, also pressures around crisis management, threats around independence when it comes to crisis management. If the supervisory authority makes a determination that a firm is failing or likely to fail, for example, in some jurisdictions, in some countries, it's not an easy determination. And sometimes supervisory authority is having to suspend a determination of that sort for fear that there aren't enough safety nets in place to address the potential risks from such failure. For example, if a country does not have a deposit insurance scheme, the supervisory authority might sort of have to delay action if it's also the resolution authority, by the way. It might have to delay action on putting the institution in resolution for fear that there might be a run on deposits of other banks because there isn't already a well-functioning and well-resourced deposit insurance scheme. And this happens in many countries, I can assure you. And so it requires the authority then to begin to have conversations with the fiscal authorities, for example, as to, well, we've made this determination. We think it might have systemic implications. There is no resolution fund ex ante set up. There's no deposit insurance fund, or it is not well financed to be able to do this work, pay out within 7 days, as the best practice says, and therefore is the fiscal resources available to do this, right? That kind of engagement can introduce a lot of political interference, right? But these conversations are going on in many countries right now, or have gone on. And again, the way to mitigate these risks is to have ex ante sort of crisis management frameworks well laid out in law, in MOUs that helps everybody understand what is it that the stakeholders in the ecosystem are responsible for, and how will these interactions take place? How early in the day must the supervisory authority signal potential failure of a firm and what the needs might be, and what does engagement with the political authorities around that look like, right? All of these can be spelled out in an MOU, for example, that is published to let everyone understand how these decisions will be made, even in those difficult circumstances. There is also some pressures that we see in terms of appointments and removals of, boards of governors, members of boards of governors, members of executive teams, of supervisory authorities. That is, as Kevin said, these are individuals usually appointed by some political authority. The extent to which the political authority could use these appointment or removal powers in a way that supports their political objectives is something that is a concern in many countries, in some countries at least, and can very quickly undermine the credibility of supervisory authorities. And so that is something that needs to be checked very quickly. A number of safeguards are important to note. One is really clear and transparent standards for appointments and removals set out in law and well protected and well enforced, right? It's extremely important to give confidence in terms of who is in place. Who is being appointed for what reasons, and what kind of autonomy they can enjoy once appointed, so that they can actually do their work without fear or favor. The structuring of governing boards and executive teams as supervisory authorities in a way that removes or at least reduces any perceived conflicts of interest, either from industry or from politics, and etc. Extremely important. And then within, I always like to say that apart from the external pressures, you also want to make sure that internally, supervisory authorities themselves are organizing the allocation of responsibilities and duties in a way that also helps to build confidence in terms of who's in office, who's in the teams that are assigned to various institutions that are regulated. That gives confidence that there are qualified, there are strong people who are doing this work, right? The process of rulemaking, if the supervisory authority has rulemaking authority, is very important. How do rules get to be made? How do rules get to be sort of enforced? What are the exceptions? What is a discretionary process? Because supervisory authorities have judgment. They exercise a lot of judgment. How should we expect that judgment to be used? Okay, what are the standards that guide the use or the exercise of judgment? Extremely important. And both in terms of how it makes rules, how it enforces rules, how it goes about supervising institutions must all be published in some operational manual that helps to boost the confidence and the respect of the public. And then issues sort of around checks and balances in terms of how, again, going back to the discretion question and decision making, internally, how decisions are made. And then in relation to external stakeholders, whether it's over climate related issues, cybersecurity, and etc., how are decisions made? What are the checks and balances in place to ensure that there's no capture, undue capture, and etc. So these are some of the things that come on top of my mind as I think of threats that are growing and how to mitigate these.
Okay, thank you very much for that, Elsie.
I
Very comprehensive.
might add one last point about
Oh,
communication. Very clear,
all right then.
consistent, very clear, consistent communication also helps quite a great deal.
Okay, thank you very much for that. Perhaps Kevin can turn to you next and start by asking you perhaps to comment on a question which has come up from the audience, which is how can we ensure supervisory independence, going by the latest example of the most powerful central bank in the world? I have a suspicion that by that central bank they mean the one you used to work for. And also, just to put that in the perspective of a couple of sort of new and emerging risks out there, one in terms of climate-related risks, and second, again, picking up on a question which has come up in the Q&A, the emergence of various forms of digital finance, where the questioner asks, how can we help ensure responsible behavior and anti-corruption measures given by the push from governments and communications regulators to expand such services to grow. So again, a question there, I think, about the extent to which supervisors perhaps might or might not have an independent view of the extent to which digital finance should be allowed to grow. So sorry, that's a slightly jumbled set of questions, but hopefully you can turn it into a coherent answer. Thank you, Kevin.
Yeah, thanks for that, and thanks for the questions from the audience. Maybe I'll use the example of the financial risks of climate change as a test case for how supervisors might think about an emerging risk. So let's start with why might a supervisor care at all about the impact of climate change? And then I'll link that back to supervisory mandates. So I think the most useful way to think about this is climate change as a driver of risks that are already part of the existing risk management framework of banks. So take a few examples. The increased risk of a hurricane could change the probability of default of a mortgage. A change in the government policy like a carbon tax or a subsidy for renewable energy could impact the profitability of a firm and change the valuation of its securities. Flooding could disrupt a bank's branch network. So in all of those cases, it's climate change impacting very traditional prudential risks like credit risk, market risk, or operational risk. And supervisors generally expect firms to manage all material risks, whether they come from a business cycle, a cyber event, geopolitical change, or a climate shock. So in all of those examples, if climate change is a driver of a risk that supervisors already care about, it seems entirely reasonable to me that supervisors should care about the risks stemming from climate change themselves. And notice that everything I've talked about has been about the impact of climate change on a bank or the financial system, and not about solving climate change itself, which is not part of a supervisory mandate, but the financial risks of climate change would be. So if I tie this back to my earlier remarks, everything a supervisor needs to be done, everything a supervisor does needs to be tied back to its statutory mandates. Supervisors and regulators take their targets, take their objectives from elected officials, and that is absolutely critical to maintain independence. But if climate change is a material driver of risks, then it seems entirely appropriate that supervisors should understand that, build capacity to identify and monitor these risks, and expect banks to manage them the same way they would any driver of risks. And I think that would be true whether the risk is coming from a traditional driver like a business cycle or an emerging driver like artificial intelligence, financial innovation, or climate change. Of course, in all those cases, supervisors would need to explain why it is viewed as a material risk, what was the analysis and evidence that led to that conclusion, and why it should be a priority in a world of scarce supervisory resources. And that's the accountability piece that we talked about earlier. So from that perspective, I don't see focusing on building capacity and understanding around the financial risks of climate change as expanding the mandate of supervision at all. It's core fundamental risk management of a new driver of financial risks.
Okay, thank you very much for that, Kevin. And what about just picking up on part of a question coming back to digital finance and use of technology and AI and everything else associated with that? I think there was a sense from the questioner as to whether or not supervisory authorities should be part of pushing for economies to make more use of digital finance, AI, and the like, alongside governments and other players who in some countries are also very keen for those channels to grow in their economies.
Yeah, from my perspective, the supervisory and regulatory authorities wouldn't have a new or independent view on how technology should be developed or implemented. Supervisors typically don't pick winners or losers across different sectors or across different competing technologies. Their goal is to ensure that the financial institutions that they supervise understand those risks and effectively manage them, but not necessarily to drive towards one outcome or another. That's the competitive market. That's the independence aspect that we talked about before, that supervisors don't go outside their lanes of ensuring a safe and sound financial system or a broader financial stability.
Okay, thanks a lot, Kevin. Perhaps back to you, Elsie, with a question that's also come up in the list from the audience, which is, if we're thinking about the independence of a supervisory authority, does that in itself imply that a supervisory authority should be separate from the central bank?
Well, just before I get to that, if you don't mind, I wanted to add a little bit to Kevin's point. The fact that while it's probably not the job of the supervisor to mandate a specific, technological approach or any other approach, it might be useful from a risk-based supervision standpoint. For example, for a supervisor to say, we identify cyber risk as an emerging threat, and we feel that the technical standards in the banking system right now need to be improved, and therefore steer, either the banking system or whatever part of the financial system they're supervising towards higher standards, right, in technology or in other approaches that help to mitigate those risks. But again, those should be done based on appropriate evidence and consultation, with a roadmap to implementation that's fairly clear and a lot of transparency around that. So I've seen that work. But to the point about how you organize your supervisory function and whether it's at the central bank or otherwise, I think that really is a matter that is specific to every country. Every country must deal with that, and the research would show that there isn't a superior model, right? If you looked at all the models, every model, supervisory model or architecture must sort of have some basic ingredients. And autonomy is required, in every case. It becomes a bit complicated, for example, and I shouldn't say it becomes a bit complicated because there are pluses and minuses. When you do have the supervisory authority in a central bank, I find that the supervisory authority could derive some benefits that those that are not within the central bank may not always have. At the same time, it could be slightly more complex because you do have the central bank's primary mandate being price stability. And I've seen a lot of times how the supervisory function is seen as subservient to that. And there could be trade-offs between the price stability objective versus financial stability, although they're very interrelated. And you find out that sometimes one suffers, and the one that will typically suffer might be financial stability, right? Because the idea is that our primary mandate is price stability, and so if there's a conflict, that's what we should focus on. So you need very clear, again, ex ante institutional arrangements and governance arrangements internally to ensure that you're spending, you're providing and allocating enough resources and enough time and other logistics to the supervisory function so that it's not buried within the broader picture. And you would find that sometimes when it comes to training and capacity building, all of that, the supervisory function is not seen as priority. And so that is something that must constantly be taken into account. But I've seen on the flip side, like I said, that supervisory authorities that are in central banks tend to have sometimes more financial resources available to them for their work than their counterparts who are not in central banks. Because when they're not in central banks, they typically are perhaps funded by the government, or by the industry, all of which are very limited in these days of tight fiscal space and tight industry profits and etc. Right? So, and then you do have the additional complexity of interference and independence sometimes, and sometimes as the supervisory function has grown, you're seeing cuts to its budget from government, etc., or because the industry may not be. You do see. Sorry about the background noise. And so, yes, there are times when that might be an advantage. But I think the important point here is no matter how it is organized, it is important that it gets adequate resources. And that conversation must be had over and over again in terms of how do you sustainably fund your supervisory function to be able to do its work effectively.
Okay. Thank you for that, Elsie. And building in part on that, but also picking up a little bit of a recurring theme that I detect in some of the questions. You both mentioned in your introductory remarks independence from the regulated industry. And I can see that there are various possible routes in which that independence could be undermined, either because the regulated industry puts pressure on governments and governments then try to put pressure on the supervisor, or positions where individuals within the supervisory authority may be incentivized to take a particular stance towards financial institutions, possibly because they're planning to work for them a few years down the road. So I'm just wondering if you could perhaps both say a little bit more about, how you see this threat to independence, from the regulated industry, whether it's funding the supervisor or not. And if you do see it as a significant threat, what sort of mitigants do you think should be put in place? So perhaps start with you, Kevin.
Yeah, I'll touch on two different topics. First, around the budget piece, which Elsie has spoken about and came up in some of the questions. Independence of financing and budget certainly adds one way that supervisors can become more independent, but it is not a free lunch in the sense that supervisors or a supervisory authority would still have an obligation to use those funds efficiently and be transparent in how those funds are being used. The expectation would be that any government authority is using taxpayer funding in an effective and efficient way, and that they would have a requirement to report back and demonstrate that in a transparent, auditable way to show how funds are being used. And I think that builds credibility when supervisory authorities do that and can explain how scarce resources are being allocated, how they're being focused on the most material emerging risk, and are doing the most to achieve the objectives and the statutory goals that they've been given. So I think that's an important part of it. On the second piece around separation from the industry, transparency is the first piece around that. Supervisors should always explain what steps they're taking and also what steps they're not taking as a way to justify their approach. And then at a much more practical level, many supervisory authorities put in constraints on individuals on the types of roles that they can take before or after they work in supervisory positions to try to limit some of those incentives that might cause a potential conflict. Going into these discussions, though, I think the point of departure for me is that the supervisory authorities almost always have a lower risk appetite than the financial sector itself. If you believe that externalities are part of the story, that's true by definition. In many other cases, whether it's different sort of incentive problems, principal agent problems, you have cases where the financial institutions take more risk than society might want. And that's supervisor's job to understand and make sure those risks are being internalized. I think a legitimate challenge here is you also don't want supervision to swing too far in the other direction and stop all risk taking. The fundamental reason we have a banking system is to allocate funding from borrowers, from savers to borrowers in a way that is supportive of economic growth. So trying to find that balance, and the part of the supervisory posture that promotes and facilitates risk taking and prevents excess risk taking is really the challenge. That's the art of supervision, and that's the judgment that Elsie mentioned.
Okay, thank you very much, Kevin. Elsie, what about your view on independence from the regulated industry?
Yes, I think Kevin has made the key point, but just to add that if funding is an sort of as industry is borne by the industry, as happens in some jurisdictions, it's very important to make that a transparent process ex ante. So it shouldn't come down to private conversations between the supervisory authority and individual firms, right? The industry's responsibilities must be clearly laid out in some broad fashion. If it's by a levy, how much is it? How is it determined? How is it calculated? How does the industry expect to be billed for it? At what point in time? So really a very sort of hands-off, very transparent and objective process. That really limits also the ad hocism and the penchant and the possible sort of risk in terms of being captured by as an institution or in terms of individuals who work there. And then also to consistently think of other ways in which the regulator could be captured by the industry, even if its core funding is not provided by the industry. I've seen examples where the industry is inviting the regulator to functions, right? Or the supervisory authority officials to functions, or sort of trying to make them sort of sometimes even asking them to be present at board meetings and etc. Or to cut a tape for a new branch that's been opened or whatever it is. So one has to consciously always think of the risk of capture, right? What are the indirect ways in which the regulator or the supervisory authority could be captured? And I always said to my colleagues, the supervisory authority is not the PR firm for the regulated industry. So I'm very uncomfortable going to stand anywhere and reading out a nice statement about the firm, because you're a supervisory authority. You never know what you don't know. And if you've got to sort of maintain very high standards of objectivity. And avoid, the potential for bias. So there are ways in which supervisors must always remind themselves of that. And then when they go on-site examinations, it's very important that they adhere to very strict protocols in terms of conflict of interest, in terms of gifts and etc., so that they are not in any way, captured, even remotely. Yeah.
Okay, thank you very much for that. Well, let's move on to a couple of, I think, related questions in the chat box. one of which was, how does supervisory independence contribute specifically to financial stability? You've both mentioned financial stability and the importance of it. But to link that question perhaps to the fact that in many countries, the financial stability mandate is given not just to the supervisory authority, but also to the central bank, and in some cases also to the Ministry of Finance. And that is also sometimes reflected in various institutional structures, for example, having some form of financial stability committee or whatever it might be called, where the membership includes not just the supervisory authority, but also the central bank, the Ministry of Finance, perhaps some of the safety net protection schemes as well. And also relating it to one of the other questions in the chat, there may also be situations where the board of the supervisory authority includes representatives from the central bank and or the Ministry of Finance. So, just a question there about both how does supervisory independence relate particularly to financial stability, but also in the context of the sorts of institutional structures that might be put in place to try to enhance financial stability and the need to work very closely and collectively with other stakeholders. Elsie, perhaps you to go first on that one, and then Kevin. Thank you.
Yeah, thank you. So as I said earlier on, supervisors are not isolated, and so they're going to work with people, right? And the government through the Ministry of Finance typically has some role or the other. The important thing is to fashion that role in a way that does not create the impression of at least a risk of capture or interference. What at least there are a number of best practices that have evolved around the world in supervisory circles, and one of that would be, for example, that you don't have the political authorities represented on the board of the supervisory authority, right? So whether it's the finance minister or anyone else who's directly involved in politics or in government ought not to be on the board, because that's direct sort of presence in decision making, right? And it's difficult to explain that it is not used at all for political reasons. And so ideally, not on the board. Or not in the top executive or in any other part of the hierarchy. And also that staff of the supervisory authority are not actively engaged in partisan politics and etc. So all of these are ways to insulate the authority from at least a perception of interference from the government. I hope that helps.
Okay, thank you very much for that, Elsie. Over to you on this one, Kevin, and perhaps you could say something about the potential threat to independence arising from decisions, recommendations, whatever they might be, that could be made by one of those joint committees focusing on financial stability. Thank you.
Yeah, I think the financial stability question is much, much more difficult than the microprudential one. It's a more complicated topic inherently than individual bank supervision. And as Elsie said, the institutional arrangements are just enormously complex. So if I think about the United States, which created a Financial Stability Oversight Council after the great financial crisis, that has, I think, 12 regulatory agencies involved, plus the Department of the Treasury, which chairs the FSOC. So the institutional structure is complex, and you have the potential for conflicting goals amongst the components of that complex organization. A second challenge is it's not always clear what a distinct financial stability tool is and how that might differ from a safety and soundness tool or a monetary policy tool. For example, when a bank is taking excess risk, there's a well-defined set of procedures that identify the risk, ask for remediation, enforcement actions, constraints on activities, etc., to address a specific issue. it is not as clear when you have financial stability risks emerging, particularly when they're emerging outside of the regulated sector, which is a place that we see an increasing role as financial innovation continues. So I think the financial stability question around independence is much more difficult, both substantively and organizationally.
And if I may add to that, and I agree 100% with that, if I may add quickly to that, it also depends on how the Financial Stability Committee or Council is set up and what its mandate is. So the US FSOC, for example, makes decisions on which financial institutions are systemically important, right? Whether insurance or, bank or whatever. In some countries, it's more consultative. So even though you have the Minister of Finance or his representative there, together with financial supervisory authorities, it is more to understand what the system-wide risks are and how each subsector is driving those risks. And then you find that in those circumstances, they don't take any decisions, right? They may make recommendations which are published as well. So again, ex-ante design becomes very important in terms of how you sort of reduce any perceived risks.
Okay, well, thank you very much indeed for that, Elsie. Well, we've reached the end of our allotted time, and we've ended on what Kevin described as the most difficult question, so perhaps that's an appropriate place to end. And also apologies to those of you who kindly asked questions, but there wasn't time for us to tackle them. Sorry about that. So I think for me in ending this, I should like to start by thanking our two excellent panelists. Pleased to see that whilst I was watching the chat, there were actually some comments saying thank you very much for your answers. So thank you for an excellent discussion. So it certainly was very, very good answers and a good discussion. Thank you very much for that. Thank you to Toronto Centre for organising this very insightful webinar. Also, thank you to the funders of the Toronto Centre, including the Canadian government, the Swedish Development Authority, the IMF, and Jersey Overseas Aid, and indeed others. And certainly last but not least, thank you very much to the audience for not just listening, but also participating actively. And as I say, producing more questions than we were able to address. But that's always, I think, a good place to end rather than desperately searching for questions when there's still 15 minutes to go. So thank you very much, everyone. Enjoy the rest of your days. Thank you.